Welcome to Talking Success, the podcast series that focuses on everything fintech. I'm your host, Darren Franks, and each week I'll be joined by a series of experts in the field who have a wealth of knowledge to share. It's time to meet this week's guest, so grab a coffee and let's start talking success. Hi everyone, welcome back to Talking Success. Yet another episode on a very nice Wednesday sort of afternoon, midday. And I'm talking lunch actually with Aman Behzad, who is a partner at Royal Park Partners in London. It's very good to have him on board. Over the last few weeks, we've been talking specifically around digital banking. We've focused a lot on payments. Again, bit in South Africa, a little bit in Kenya and Nigeria. We've had obviously MasterCard on, and I hope everyone has listened to the episode with Mark Elliott. That's super insightful, and he gave a slightly broader view on what's happening across the continent. Today we're going to dive into something a little bit different, and we're going to be talking about all things funding related. Obviously, very topical at the moment. There's been a bit of a fintech winter. I think that would be fair to say, with valuations being sort of, nosediving and capital generally becoming hard to come by. Although there have been some very significant rounds that have been announced over the last couple of months, which Aman, I know, has been involved in a couple of those, which we're going to delve into. So before we get started, Aman, I'd love you to give an intro, a bit about you and your story. Tell us a bit about what Royal Partners does as a business, and then we can get into sort of some more topical conversations.
Sure. Thanks for having me, Darren. So Royal Park Partners, in a nutshell, we are a corporate finance advisory firm. We support financial technology businesses and only financial technology businesses on their capital raising and M&A endeavors. So that could be raising capital from Series B funding rounds all the way through the letters of the alphabet onto trade sale and IPO, where we also engage in lead IPO advisory. We have a global mandate with two offices, London and New York. And from our two offices, we support clients as far west as Chile and as far east as Australia. We've done deals out of both of those geographies over the last 4 years since we've been around. We've completed over 40 fintech transactions in that time. So we are by far and away the most active fintech advisor globally.
Let's, I know you got East and West. Let's try and bring it back sort of a little bit centrally, because most of our viewers sort of focus in African continent, on the African continent. I know you've been involved in a number of big ticket deals here. We've got Yoko, Cash, Lulaland, BVNK, Tunes. I know Tunes is kind of headquartered in Singapore, but they obviously operate quite extensively here in Africa. So how did that come about? How did you start getting involved in the African fintech?
Sure. So I actually spent the first 11 years of my life growing up across Africa. So a very strong affinity with the African continent. I was born in London, 6 months old, bundled off to Sudan, Juba, now South Sudan, and spent the ensuing 11 years living across Africa, east, west, north, south, including South Africa, Malawi, Nigeria, Kenya, as I said, Sudan, sometime in Egypt. So really got to know the continent intimately, and always had an affinity for the geography and the various different nuances that exist in each of the different regions of the continent. I think when you look at fintech innovation, you really have the archetypal journey that's taken place, really from Europe, in terms of people going from being banked, people going from not being banked to being banked, to having a relationship with a telecommunications operator, going on the internet, getting internet banked, and sort of going across the classic journey. In Africa, because the speed of innovation has been so fast, and the speed of growth and increase in people's incomes has been so fast, not so that slow and steady increase that's happened over hundreds and hundreds of years in Europe, you have essentially gone and leapfrogged a number of those different innovation or evolutionary journeys that have taken place over the last 100 years. And so it just makes the continent that much more exciting, that much more vibrant in terms of how consumers and businesses interact, how they conduct themselves in terms of transactions, how they move money amongst themselves, and how they look after and secure their finances and their financial futures. So it's just always been an area of massive innovation, and that's why I've always sort of followed it with a keen eye.
And well, I don't guess, but Africa is driven, or fintech in Africa is driven by need and necessity, as opposed to it being sort of a luxury item or a convenience item, of which arguably it is in developed markets. When we're looking at financial inclusion, certainly in some of the ventures or some of the businesses that you've been involved in, they have a mandate, and they have very much a direction in how do we financially include not just Joe Public, but merchants. So people that want to set up businesses. Yoko is a great example of that, as is Lululemon. So, actually having a social impact is a big aspect of fintech here in Africa. Is that something when you're advising your fintechs or your clients who are fintechs? Is that something you're advising them from an African perspective to really focus on, or does it depend business to business? Obviously, Tunes is a very different model to Yoko or Uke, for example.
So I think it really depends on the nature of the business, and every business has an element, if you're working in emerging markets, of financial inclusion and prosperity and development. I think you really have to think through what is the core proposition of what you're trying to achieve. And then what stories read through in terms of the use case of the product that you can clearly point to and say, well, that is a very clear socially beneficial activity that we've just undertaken for a certain kind of age group, or a certain or agenda, or other. I mean, when I look at some examples, so Lululemon, prima facie, or Lula as it's now being rebranded, raised money for them with Lightrock Capital Partners. Also participating in the funding round was Women's World Banking and the IFC. Now you'd ask, okay, the IFC find development mandate, Lightrock Capital Partners, obviously a tech-focused investor looking for financial returns. Why Women's World Banking? Well, if you look at the data that exists in Lululemon's customer database, you find that actually 45% of those people taking lent credit and opening up effectively banking facilities with Lula are actually first-time businesses that are run by women. And you see this massive African empowerment movement for women in Africa being driven by Lululemon, where these are businesses that have never had access to credit. They now have access to credit. They now have access to banking facilities. And you have these women-run businesses, which are often actually also women-run businesses that employ huge amounts of women because they may be involved in certain kinds of fashion or a production of local goods and accessories, being now funded and having the facilities that they need to be able to make and accept payments, receive credit to be able to buy goods on account, and be able to create that value and add to lift themselves and their families out of poverty. And often enough, if you look at if you look at the survey results of many of these female founders of businesses that Lululemon serves, you find that actually it's a single income household. It's the woman that's now doing the work.
Right. Wow.
So a very strong empowerment agenda in these companies.
Let's take it back a step, if I may. In terms of the work that you do for your clients, again, if you want to use any of those as kind of examples, then that's your prerogative. Can you explain to us what it is that you guys do as a service, and how do you get involved? What value do you bring? What stage do you get involved, etc.? Can you give us an overview?
Yeah, sure. So there's many different flavors of the kind of advisory services you can receive from advisors. We consider ourselves full service advisors. So we have a full soup to nuts model where we work with a company from the first bit of dialogue that we have. And we often say we'd like to work with companies as early in advance of a fundraise as possible, or a capital event or a sale, so that we can help shape the story, help give feedback on the business, and really go on that journey with the business ahead of time. But it's really preparing the company to be able to engage with investors, buyers of their business, shortlisting the parties that we think are going to be the most likely to want to transact with the propositions that the business has, and really highlight, and then focusing on our time and attention on highlighting facets of that business that are going to be particularly attractive to a certain buyer group or a certain investor group, and really having a keen understanding of the strategy and focus of those different buyers and investors, such that we can really spend time polishing up and refining the story that leans in to those kinds of investors and buyers. We then manage the outreach process. We speak to those investors, buyers of businesses. We connect them with the management team, facilitate dialogue and discussion, ultimately due diligence, securing terms, closing a transaction, and supporting with the negotiation of optimizing deal terms, whatever they may be, and effectively guarding and being the custodian of that money into our clients' bank accounts. When you talk about the services that we offer, and sort of talking a little bit about the elements of that journey of the first engagement with the client to the endpoint of a transaction outcome. When you first talk about engagement, again, as I sort of gave alluded to that example, it's really thinking through what are the key facets and elements that make this a very attractive business, and how is it particularly leading into the certain kind of universe that you want to go and speak to. I'm a big believer that actually the buyers of African businesses over the next 10 years will predominantly come from other emerging markets. They will come from Latin America. They will come from within Africa, and they will come from Southeast Asia. And the reason for that is not because of some kind of geographical similarity, but because very often a lot of these companies want to follow their customers and their clients and their client profiles across different emerging markets where increasing cross-border trade is happening. So being able to understand that and realizing who has what kinds of clients and marrying up those kinds of different client profiles, really understanding what is it that is going to strike a chord and have a nuance with the right level of senior person in that buyer or investor group. And then bringing them to the table and orchestrating those discussions such that we can really optimize for what kind of ideal outcome our client is looking for.
Okay. I think the majority of fintechs that are founded, globally, have aspirations either to become a unicorn or to do a trade sale or even, IPO. What stage would you typically, I know you said you go through sort of the whole alphabet, but where typically would you get involved? Would that be sort of, seed round? Would that be Series A? Is that when it starts to make sense to sort of engage with you guys, or how do that work?
So it's really the first bit of professional money that comes into a business, the first significant sets of checks. So that would be really from Series B onwards. Right. So minimum sort of $25 million coming into a business would be where we can add the most value. I think before that time, you're really funding through high net worth individuals. It's very much smaller local venture capital funds that already exist on the continent that you need to get to know. I also think what's important is to realize that the funds that you want to engage with when you get to Series B want to see the fact that a founder and a founding team has shown the persistence and the focus and the resourcefulness to go out and find and secure funding for their businesses up until and past the Series A. Being able to raise the first $10 million, let's say, to support your business, $10 to $15 million to support your business, is the marker of actually a good founder and a good founding team. And so that in itself, doing it by yourself, is a proof point that Series B funds and more mature funds look at when it comes to engaging with a company.
Wow. Okay. I didn't know that was kind of a yardstick, but it kind of makes sense, I suppose. So people listening to this podcast, again, we have quite a wide array of listeners, from people that are literally bootstrapping, fintechs, all the way through to, execs publicly listed, fintechs on NASDAQ or FTSE, whatever it may be. So if you were to give some advice, and I appreciate it's not a broad brush, right? You can't give the same advice to a startup as you do to, a Lulaland or someone at that sort of level where they're looking at Series B, C, D, etc. If you're talking to a slightly earlier stage, maybe a seed or Series A, what are the fundamentals they need to get right? Apart from obviously having a track record of raising capital themselves, what else do they need to have sort of lined up in order to come to you or someone of your stature and say, right, we're now ready to go for a Series B, without them having to then spend 6 months trying to get it all? What's some of the best practice fintechs can have to go on this journey?
So I think part of what we're able to do is actually help organize our clients such that they're able to lead into a Series B. So that can involve helping them with their financial modeling, helping them think through how to present and manage their pipeline. But really, the thing that sort of doesn't lie. And what we really need our prospective clients to have is to have demonstrated product market fit and show traction. And traction ultimately, it's great when you show monthly active users, downloads, or sort of customers that are registered to use your platform, numbers of accounts. But really, you want to see hard financial traction. You want to see revenue generation. You want to see some understanding of unit economics for a customer cohort basis or a particular customer grouping, and really understand what is the dollar that I need to spend to be able to onboard that client, and how much revenue do I generate from every dollar. So being able to have a very solid grasp of your unit economics and having genuine traction, being able to prove that you can punch past $5 million of revenue and have a strong growth trajectory, north of, let's say north of 60 to 70% a year, really being able to demonstrate that's crucial. That an advisor can't help you with.
And how important is EBITDA profit for when you're coming to Series B onwards? I think the whole sort of narrative, if that's the right word, has changed over the last year or so. I know I've been to lots of pitch events, and the questions that are being asked now of fintech founders versus what they were a year ago are very, very different, right? I'm focused on what's your route to profit, how long are you going to be into your, whereas a year ago it was like, how many users are you going to get, how many downloads are you going to get, what's your customer acquisition, etc. Have things changed because of the sort of global economic climate, or is that sort of just I don't know, a sign of the times?
Yes. So I think the first thing to say is so for early stage businesses, there is some level of immunization from the same pressures of profitability that exist in Series B, C, and beyond companies and public companies. There isn't that same obsession with path to profitability and being profitable. If you're a seed or Series A business, because you are an early stage business, you are expected to have losses for a foreseeable period of time. So the same pressures don't exist when you're aligning, if you're a seed or Series A business on your journey, and you're sort of ramping up to get to a point where you're ready to undertake a Series B. When you do get to the point of Series B, though, or when you're sort of approaching a fundraise, I think there are some important things that you just need to remember, which is if you are looking to get venture capital funding, firstly, you still have to have very attractive growth rates. There's no escaping that. You need to be able to demonstrate that your business can grow at 1x, 2x per year. And you need to have done that successfully for a couple of years. So, you're coming off small numbers, so you should be able to achieve those kinds of growth rates, going from 100K to 200, 200 to 400, 400 to 800, and then, 1 million to 2 million. These should be achievable if your company has the right sort of, the right mix of what it needs to have from a product market fit perspective. And the second thing is really having a strong grasp and an understanding of your unit economics. Now, unit economics were just something that people used to throw out there as, theoretically, what is the art of the possible in terms of how popular customers are. You need to have a much better grasp of unit economics and really understand what is the fully costed requirement for you to onboard a customer, and how much revenue do you generate from them, and not necessarily on a lifetime basis, but much more short-term focused over the next 3 years, maximum 5 years. What is the CLTV, customer acquisition cost payback, the customer lifetime value to the cost of customer acquisition? And that really needs to be in excess of 5x in today's world, 4 to 5x at a minimum now to be an attractive business. You need to have your payback periods for every incremental customer acquisition that you're making to really be less than 15 months and ideally less than 12 months. And the whole thesis behind unit economics you need to remember is if I were to switch off my marketing and the growth engine of my company, could I turn my company profitable overnight? And that has to be something that you are constantly thinking about as a founder, as you're getting increasingly mature, as you push past seed, after you've done your Series A and you're setting yourself up for your Series B.
That's some really good advice. Thank you. I read an article that you, I think you were interviewed in a few weeks ago, and you were talking about sort of the landscape and who would be sort of potential acquisitors for fintechs. And from what I read, and please correct me if I'm wrong, Aman, but your view is really different in terms of it's actually probably not going to be the banks or necessarily the sort of PE funds and what have you. It's likely to come from within industry. So could you sort of elaborate a little bit? And do you see there being quite a bit of traction for the maturing fintechs to then go and sort of start making strategic acquisitions across different markets?
So I think what's important here is, so I do not see banks as being large acquirers for fintechs. Yes, they may make one or two big acquisitions, and they may every year buy a fintech company. But the extent of what banks are capable of doing is hindered by their own accounting approaches. So if they were to make a big acquisition, the fact that when you acquire a technology company, you have to immediately impair the intangible assets. So you're already, so you're sort of taking a double hit. You're paying for an acquisition, and you're also having to write down the value of your own capital. So that becomes quite prohibitively expensive for a kind of an old school bank to make an acquisition of any significant size. And if you're a bank acquiring capabilities, you very often end up crushing the fintech business that you're acquiring in the first place through your own bank's policies, particularly security, and the security policies that you may have, the compliance processes and approval may end up effectively choking the business that you end up acquiring. And then just internally, the amount of bandwidth that you have as a bank to be able to acquire multiple businesses and integrate is just very, very limited. If you're a fintech business, you're used to running fast and breaking things. And so you the approach that you take, and there has been a bit of a tempering of this, but it's more of you ask for forgiveness as opposed to asking for permission. Yeah. So really motoring ahead with your plan and then trying to fix things ex post the event. When you're a fintech business yourself, you gain an appreciation for what it is to build a team, what it is to build a certain kind of technology stack, how hard and how difficult it is to build certain customer sets. And that appreciation that you have, you then can admire and see in other companies where you can perceive their value, where investors and other strategics may not be able to perceive their value. And so right now, in a world where capital is scarce, there are a lot of smaller companies out there who don't really have an independent future. You as a let's say as a moderately or modest size fintech business need to ask yourself, are you going to be a consolidator or will you be yourself consolidated? And that will be a core part of the thesis as you set out your business plan for the next 3 to 5 years. If you see yourself as a consolidator, then now is the time to get acquiring. There is probably a 12-month window when things are still going to be reasonably priced, where you can acquire high quality tech talent teams and keep them motivated and incentivized within your organization. Because remember, you are a fintech business, so you will have a lot in common with the company that you're acquiring. And in that window, you'll be able to pick up bargains when it comes to those kinds of capabilities, which otherwise would have been prohibitively expensive. Yep. If you wait longer than the next 12 months and you're sort of hoping that your own funding situation radically improves or the market perceives your value as much higher in the next couple of years, those companies will already either be A, bankrupt and will have to shutter, B, being bought by somebody else and being acquired already, or 3, would have actually managed to get themselves together and be successful as an independent company and then just be too expensive to be acquired later on. So now is the time to be making acquisitions if you're a fintech business. And I think a lot of the companies that we're speaking to have really realized that. You mentioned at the start of the call, which maybe just before we started the recording, Trustly acquiring SlimPay. So SlimPay is one of our clients. Again, it's a European transaction, so maybe a little bit less relevant to your audience. Trustly's gearing up for their own IPO journey, their own IPO plans, and they have been for a while now. They're looking to bulk up and increase their scale and capabilities in other countries, and you're going to see this as an increasing trend, both on the continent and outside the continent of Africa.
And I think we've seen exactly what you're talking about, man. We've got Rapid that new business. So, that was quite big news. We've seen some additional funds, Network International, the DPO group, and then sort of sell that to a Canadian business, which I think was relatively recent as well. So there seems to be a lot more activity, certainly than in the beginning part of this year. What's your view on trends? I know you've just mentioned this sort of 12-month window in terms of making acquisitions. But if you look slightly broader than that, in terms of fintechs being able to secure funding at sort of BCD onwards, is there still a market for that? Is it harder now to come up with capital? Are you seeing valuations still being taken in for a big hit? Are you seeing some sort of recovery? What's your view on the sort of market and sort of trend moving forward?
So generally speaking, the early stage was insulated from the last 18 to 24 months of pain. The early stage investing has still continued. People carried on deploying. Valuations have been moderated slightly downwards, but not materially so. So slightly smaller rounds, slightly lower valuations, but the pace and speed of capital deployment has continued. So that and by early stage, I'm talking about seed, pre-Series A, Series A. What was really badly affected was Series B, C in particular, funding rounds. Those have been hit disproportionately badly. And that's because it's in those two funding rounds where you're making a big bet, whether when it comes to, you're looking at a company at Series A and saying, yep, this company works. It looks like good traction. If we throw some more money at it, Series B, we're really expecting it to grow, but we don't know if it can grow beyond those early adopters. We don't know if it can grow beyond that one loyal customer base that they've managed to nurture to prove that the Series A work, to prove that they developed with the Series A funding. And so there's a lot of belief required at the Series B. And then at Series C, you're really trying to monitor and maintain yourself from falling into becoming a private equity profile company and maintaining yourself as a venture capital profile company. So again, another really big leap there of whether this is a extremely high growth company that can be maintained outside of its core markets. So you're having to, those are the sort of the highest risk stages of capital deployment to return. And those really, really, really dried up. I mean, that money just basically, checked out for the last, call it 18 months. We are seeing those funds coming back now. And Series D, Series E, the later stage stuff, that was always that's continued, not at the same pace as it has done historically, but it has continued. A lot of those businesses that needed to receive a Series D, Series E check had already either reached escape velocity and were profitable, could carry on and not need to make another raise, or have said, you know what, we're actually okay to become a profitable PE profile company, lower growth, and we'll get ourselves on a slightly different trajectory and tighten up our operations so that we don't need to do a Series D or a Series E. As I looking forward into the market over the next 12 months, where are we now when it comes to private capital deployment? Well, anecdotally, a lot of calls from a lot of funds about wanting to get busy. They've effectively sat on the sidelines for the last 18 to 24 months. If they're on the sidelines for any longer, it really calls into question the whole industry. If you're not deploying money now, when will you actually deploy money? And LPs will be rethinking their entire fund allocation process in the next cycle. Are you somebody you can actually allocate capital effectively throughout an investment cycle? So there is a desire to deploy money. There's been a strong narrowing of the bid-ask spread between private companies and investors or buyers. So there's an understanding now that people are much more pragmatic around terms. You had the Ramp CEO, for example, in the US, really celebrate the fact that he raised $300 million at something like a 30% markdown on his last funding round. That was an item for celebration. He went out to the market and said he's really happy that he got it done at the valuation that he got it away. And so, people understand that this is not a source of embarrassment to sort of engage it, to have down rounds or to have funding rounds which don't necessarily work out in the way in which they should have circa 2021. Times have changed, times have moved on. It's really about being able to thrive as a business once you sort of draw a line in the sand between the past and the present. And then finally, when you look at the public markets, we have a B2B index and a B2C FinTech index that we publish every week. Our B2B index is up about 15% year to date on the FinTech side, and our B2C index is up around 25% year to date. So we've had, call it 9 months of really strong traction in the public equity markets for FinTech businesses. And really that's the period of time, pricing stability and valuation stability that private investors need to be able to underwrite an IPO 3, 4, 5 years down the line, and therefore discount back to the valuation of companies today. And so on that basis, we have, in my mind, a very nice perfect storm of high performing public market equities, meaning people having confidence in public market valuations and an ability to go public at some point in the future. Not today. Today is still a pretty shocking time to go public, but at some point in the future. And a realization that you need to deploy capital. Otherwise, the whole VC model effectively starts to break down.
We've also just spoken about how does at what stage and what sort of advice or where do you get involved from a valuation perspective? Because I think you probably find that you raise maybe a seed round, a pre-seed round at a number. Then you're looking at Series B, which is you said $25 million plus. How do you work with your clients, which are the fintech, in order to come up with a sensible number based on valuations? Is there a set formula, metric? Is there go on market conditions? Where do you start?
So I think that the first question we always ask our clients is, what do you want to optimize for? So there are in my mind, there are four key things that you're trying to solve for as a fintech business looking for investment capital. The first is valuation. What's the valuation that you're trying to solve for? What was the last post money? How much of a mark right up do you need for your next round? And how much capital are you trying to take to avoid the level of dilution that is intolerable for you as a founder? And how much money does your business actually need in terms of being able to fuel itself for the next 18 to 24 months versus what's a nice to have? So that's the first thing, valuation, which determines dilution. The second thing is terms. What are you willing to sacrifice and give away on terms? Are you willing to give away a board seat? Are you willing to give seniority of liquidity preference? Are you willing to give away participating preference versus non-participating? Where do you sit in terms of the level of stricture that you're willing to expose yourself to when it comes to terms? Because you can have very, very aggressive terms, but actually a much higher valuation. If you want much cleaner terms, your valuation will be lower. I think the third is the speed at which you need the money. If you need the funds yesterday, then you need to compromise on your valuation and your terms, and you see whatever the market's going to give you. And the fourth is the identity of the investor that you want. On one end of the spectrum, there's just basically dumb money. And if we were to rewind this conversation, 18 months ago, a lot of businesses, a lot of founders would say, if it's not Sequoia or Accel, I just want the dumbest money on the market. Somebody will just give me a check and let me get on with it. Well, now that's not the case. Everybody wants to have investors that are going to participate at the board level, that are really going to help with contacts, connectivity, experience, really help the management team work through difficult times as well as good times. They're looking for partners to help do that. And a number of deals that we've recently done, we've opted for lower valuations and worse terms with investors which vibed better and had a better chemistry with the management team. The management team could look in the eye and say, I really want these guys in my corner for the next 5 to 10 years versus better terms, better price, better everything. But it was clear that these investors were not going to be the guys who are pitching up for every board meeting, giving ideas and trying to open up their Rolodex to grow those businesses. So really, you as a fintech business, you need to figure out what is it that you're willing to compromise on and what is it that you're not willing to compromise on. And that's unique to your business's circumstances.
And I guess the individual, I mean, if it's, there's a couple of co-founders, it's what do they want out of the transaction as well, I suppose. That's probably quite important from a selfish perspective. If I'm going and raising, what do I want to take to the table? Is that a conversation that also needs to happen, or?
So at Series B, you should not be having that conversation on what you want to take off the table. That doesn't happen up front. That conversation can happen much later on. So once you receive term sheets for primary investment, you do not want to go to market saying, yes, there's primary and secondary here. It's just a very difficult message, particularly in this market. Nobody wants to be perceived as a fool for cashing somebody else out of a business. and coming in at a much higher valuation of the business. You need to figure out exactly the reasons why. Founders to take a little bit of money off the table at Series B is perfectly normal, perfectly usual, and it's kind of par for the course, and it should happen. I think it's a very healthy thing to happen, where founders have been working hard to get to a Series B. They may be working for 3, 4, 5 years. They need to have, for themselves, for their own mental well-being, and also for their family situation, to show that actually this works, and I need to stick at this. Because typically these are high achieving individuals who had high paying jobs, and their families are now putting pressure on them to say, this actually, you've been here half a decade. What's the return for us as a family? Just seeing you much more stressed, working much longer hours, but not the same financial reward. So it's a very normal thing to take some money off the table for founders, but you don't want to be discussing secondary, I think, at any early stage in a Series B process
as well. I've got a question around jurisdictions as well. I think there's, you've obviously, advised companies, South African based. I know one's now headquartered in Singapore, one's headquartered in London. If you're a fintech operating in Africa, and let's just make that a little bit more specific, South Africa or Kenya, I'm by no means favoritism, I'm just using two as examples, right? In terms of your structure, how should that typically look from looking at investment and looking at overseas investors? Are they looking at a complex structure where you may have an offshore headquarter in Mauritius or somewhere else? Is it better to have a cleaner structure so you're just domiciled in the country you're operating in? If you've got branches, they're branches of that sort of holding company. Is there any advice you can give? Because it's a bit of a what's the correct way of saying it? It's a bit of a complex area. I've been through it myself a couple of times. So any advice you can give?
Yeah, it's so yeah, there was a period of time where every South African tech company was putting their whole co in Mauritius and putting their IP there and using the Mauritian entities as a safe house. But Mauritius itself then came under scrutiny from the European Union around what their sort of AML processes and how money was sort of coming in and out of the country of Mauritius, which I think grey listed them for a period of time. I can't exactly remember, but it just made Mauritian investing really no different to just going directly into South Africa. I think in my experience, going to a third country, if you're a South African, Kenyan or Nigerian entity, which is not either the UK, the Netherlands, Ireland, or the US, doesn't really make sense. I think other geographies, other jurisdictions are going to be equally exposed to different issues and changes with legislation, global sanctioning, global rules around how those companies can operate, what they can operate. I don't think you want that additional headache. I think if you're what's typical for a Nigeria businesses, a lot of them are Delaware headquartered, US Incs at the top co, works perfectly fine, is pain when it comes to legal fees, because you're having to have a US based counsel as well as typically a Nigerian based local counsel, which is just a bit of a pain because there's not as many lawyers who are comfortable with both Nigerian and US law. So you typically have to double up on law firms. So just be aware of the cost associated with that. That's why I think generally speaking, the Netherlands, the UK, Ireland to a certain extent, generally the Netherlands and the UK are the preferred destinations. Netherlands because they're still within the European Union and they haven't gone through the pains of Brexit that we have in the UK. Otherwise, it would just be straight up saying the UK is probably the best place to domicile your top co. And it does make a difference by the time it comes to investor interactions.
Sorry, man, it does make a difference.
It does. It absolutely does. Yeah, it does. It does make a difference.
It's not just a case of, incorporating in the UK or in Ireland or in the Netherlands or in the US. These days you have to have substance. There needs to be a operating business. Decisions need to be made there. So I think, for anyone that's thinking about, maybe you're an African fintech and thinking about having sort of a headquarters offshore, it's not just as simple as, post box these days. You have to have substance. You have to have, all your decisions being made within that entity. Again, if you're South African and you set up a controlled foreign company, So you don't want to be having like those conversations because it's going to cost you more than legal fees. I can promise you that.
Yeah, no, you're absolutely right. You do want substance. A number of the companies, Yogo, for example, has created a center of excellence on the tech side in the Netherlands. The biggest issue that the African continent suffers from is a flight of skilled resource. People graduate from universities, technical colleges, they work for a few years in a bank or a tech business, and they get offered visas to go to the US, Canada, Europe, because there's a shortage of highly skilled tech workers. And so you have this continuous churn flight of technical quality and capability out of the African continent. And so very often you need to have these technical centers in London or in the Netherlands or the US, where there is that technical skill on the ground, which can augment and support.
Yeah, but there's a big cost associated with doing that, right? Because if you start paying, salaries in the Netherlands or the UK, and then you're trying to work on your economics, that has a big impact on that, right? Because your cost base, all of a sudden your OPEX goes through the roof because of, cost of labor. Where if you're offering a solution here in Africa, where typically, the actual dollar value is a lot less, is that not harder then to sort of make money off of that? Does that work if it's at scale, or?
I think there's a recognition that it's very hard to find high quality African tech talent. And so you can definitely have a product on the ground in Africa. You will find technical developers, etc., and great high quality coders and developers on the ground across the continent of Africa. Really, when you're talking about fintech businesses that want to scale across more than just one country, have ambitious to become unicorns, you're talking about a level of being there, done it, hiring that you want to do. So you want to hire senior product tech people from the likes of Revolut or Monzo, etc., those kinds of places. And typically those individuals are not located in Africa; they're located in, European capitals.
I think if I had $1 for every time a fintech founder has told me they want me to go and hire them, the head of product from Revolut, I'd be a very wealthy man without having actually to do anything. Because I think that again, it's important though. What was it on this topic? It's important that I think fintech founders or people working in fintechs recognize the fact that, you can't just go and cherry pick. You can't just go to the head of, product Revolut and go, come and work with me and I'll pay you, $100,000 on the basis of, look, I'll give you some equity and we might become a unicorn. I think there needs to be a bit of realization there of actually what sort of talent you can attract based on where you are as a stage of business, what sort of risk appetite people have. And really what the business, not just a case of, we're going to set up an office in London, and get the head of Starling Bank, and I'm going to get the head of Revolut, and I'm going to get the head of whatever other fintech we've got over in the UK. There's a bit more work that needs to be done behind the scenes, I think.
Yeah, no, and look, I totally agree. I think there was a period of time in 2017, 2018, where a number of African businesses had gone straight to recruitment agencies in London and put out tenders for positions for high, let's call them high value senior, particularly tech and financial and CFO type people hiring that they wanted to engage in, and we're very happy to pay very large finder's fees. But they all faced challenges in terms of recruiting their headcount. I'm a firm believer in that, and I don't mean to sort of shoot down the talent management world and recruitment world, but I think it's very hard to see these being successful hires, particularly when it comes to emerging markets type businesses, unless it's come via personal network or personal recommendation or somebody's put you in touch with them, because the connection needs to happen at a much more personal level, and it needs to be vision based as opposed to sort of mathematical.
Yeah, listen, I think the days of it being a match for a CV, the CV matches the job spec is long gone. I mean, that's why, we as a business, we just focus on fintech, right? In emerging markets. So we know the market, we know the people. Someone gives us a call and says, it's FO that's done X, Y, Z. Yeah, actually, they're probably sitting here on my WhatsApp, and I can give them a call. And that's the difference. I think if you're a foreign fintech going into another market, expected to get labor from that market, you don't know people from Adam. I think culturally there's always a bit of a mismatch as well. We've seen that a lot. We want someone from the UK or from the US or from Europe to come in. They come in, they have their own ways of working. It's very different running an African business to running a European business, just in terms of culture, if nothing else. And that sometimes very disruptive rather than, having the positive effects.
And this loops us back into the conversation around investors. When you're choosing your investor, what kind of Rolodex does that investor have? Have they done deals before on the continent of Africa, or is it the first deal? And if they do their first deal, what value will they actually bring to you? Can they source for you other senior executives? Who have already worked on the continent of Africa? They may be bigwigs from other established financial services organizations in other countries in Africa. What kind of capability and understanding do they have of emerging markets? And again, their Rolodex, what kind of understanding capabilities does that Rolodex have of emerging markets? It's really that reverse interview process that you need to do as a fintech founder.
Aman, where can people find you, and where can they find out more about what you guys do, and maybe get in touch? What's the best route?
They can email me directly. So it's Alpha Bravo AB at royalparkpartners.com. They can go to our website to find out more about our business, www.royalparkpartners.com. You can find out about some of the transactions that we've done. We've got our case studies there. We also issue weekly market updates, which we send out both weekly, so also weekly, monthly, and quarterly. The quarterly ones are more fulsome, much larger review of the market. And then every quarter we also issue a thematic report on a different subvertical. So we actually issued one on Africa, I want to say about 6 months ago, which covered off African fundraising, some of the trends and technologies that are emerging there, some of the attractive businesses. We'll be issuing one very, very shortly on core banking and banking and service companies, and so on and so forth. So we strongly advise anybody to look at that. And then also for anybody interested in valuations and multiples, we have a free access online database that people can log into and play around with our spreadsheets and get market data around.
Fantastic. Well, I'm going to get those links from you, and I'll put them within this podcast. If you're watching on YouTube, they'll be on here. If you're listening on Spotify or Apple or Google, then the link will be in the description. So please feel free to navigate around those and reach out to Aman if you'd like any more information, or you'd like to have a chat with him or someone from his team. Aman, thank you. I've learned a lot this episode. I'm sure our viewers will as well, and our listeners. Any sort of parting words? Anything you want to leave us with as a kind of a cliffhanger? Because maybe we'll get you back on soon.
Sure. Look, we've literally just finished the first innings here. If this was and I'm going to go for baseball versus cricket. So there are not 3 more innings to come. There are many, many more innings to come in the world of the evolution of the fintech sector. We've just completed, let's say, the first decade of what will be a multi-decade, next 40-year transformation of the industry. So we're still incredibly nascent. There is going to be a whole load of money going into this sector. There is going to be a whole load of very interesting, exciting category views that will continue to emerge. There will be businesses that come and dominate countries and regions and continents over the next 10 years. And many of them you may not have even heard of yet, or may not have even been founded, just such as the pace of change and the ability to take market share in the current market setup. My recommendation is for everybody to persist, carry on, keep growing your businesses, keep an eye on your cash flow. And if you need help with any of the above, then please feel free to reach out to us, and we'll see if we can be of any assistance.
Listen, I'm certainly excited about the future of fintech, not just here in Africa, but I think globally as well. We're seeing some incredible innovations. They've only, like you said, they've only even started. We're not even going to sort of talk about crypto because that's a whole nother 2-hour session. But and open banking and everything else, and the amazing work the guys over at Ukesh are doing with one of our mutual clients at DTB Bank. But that's one for another time. Aman, thank you so much. I'll let you go back to your maybe you're having a cheese sandwich, given you're in the UK. I don't know, but I'm going to go and have something South African over here. Wasn't here. And that's a wrap for this week's episode of Talking Success. Thank you so much for tuning in and joining us for this fascinating discussion of all things fintech. We hope you've enjoyed this episode and gained some valuable insights into the ever-evolving world of finance and technology. A huge thank you to our guests for sharing their expertise and providing us with some amazing insights. We certainly couldn't have done this without them. Don't forget to subscribe to our podcast and stay tuned for more exciting conversations with experts in the field. Until next time, keep learning, keep growing, and keep talking success.